So, are we in a recession, or is one imminent? So there is this thing called the National Bureau of, anyway, so with the, it doesn't matter, economic research, they have a business cycle dating committee. And so it's actually a group of people, and their whole job is to say, are we in a recession or not? And if so, exactly when did it start? And they have their job lets them, like, they can wait a year to say, oh yeah, there was a recession back there. So it's an interesting idea, and they have a marketing department apparently, because they have the 3 Ds of a recession: of depth, duration, and diffusion. So how deep it means is how hard it's hitting. Duration is how long has it been affecting things, and diffusion means is it affecting the whole economy or just individual sectors of the economy. And so this is their standard for what a recession is. If it's just for, if everybody's out of their jobs for a week and then you're fine, that's not a recession. It didn't have the duration. If you just batter a single sector like technology or energy, but the rest of the company is fine, again, that's not a recession. And if it's affecting everybody, but it's just a little bit uncomfortable, then again, that's not a recession. So it has to meet all 3 of these things. I thought of, like, can you have like length, latitude, and lack of levity or something like that? You could have a different, obviously my marketing department, or me, I'm not in, our marketing department's great. Me as a marketer is terrible, so I think their 3 Ds are better than anything else. But they're just trying to come up with something that describes like what a recession is. So what that means is that it is not something very straightforward like 2 quarters of negative GDP growth. Standing here after 2 bad quarters, I understand the emotional impact of, anything bad can happen in 1 quarter, but 2 quarters in a row really hurts. But it is not something, it is not a simple definition as that anymore. So, of course, whether that matters or not, we're getting into technicalities, and with lots of argumentative kids in my household, if any sentence starts with technically, then we're not going to listen to the rest of that sentence. And in some sense, economic information is like that too. Whether you're technically in a recession or not, whether you just barely get over that threshold, whether you're technically in a bear market or not, whether you're at negative 19.6 or negative 20.1, doesn't matter, right? Nothing magical happens when you cross these thresholds. And so you don't want to put too much importance on that. But if it's down a lot, if the economy is slowing, then the market's going to react to that. So the indicators that do matter are things like GDP and which is gross domestic product, like production measure, and also gross domestic income. So on the headlines, you always see GDP, which is what historically the Fed has measured. But actually, GDI is something that is more accurately measured. And so these are and GDI is still slightly positive, and it tends to be a more accurate measure. So this is why some people think that technically, and we may not be in a recession, just even from the GDP perspective. So I think it's kind of interesting to say, what are the factors going in here? What does the economy really look like? So going into their 3 Ds, clearly this is diffuse. This is affecting everybody. It's kind of a continuation of the pandemic. We're all hurt in terms of the markets. If you look at sectors of the economy, like every single sector is down except for energy, right? So it's really markets and the economy is getting hit in a very broad way. If anyone is thinking about ESG investing or other things like this, they haven't done well because the only thing that's done well is energy stocks. So if you haven't owned energy stocks, then you will have done worse this year than if you did. So the depth calculation is the one that I kind of wanted to illustrate here. So you can think of GDP, which is negative, GDI, which is just a little bit positive. But what about employment? Employment is incredibly strong. That's a sign of a strong economy. Consumers that has slowed down a little bit, but people are still spending, right? That's been a lot of what's been driving the inflation driving a lot of the economic activities. People are really spending a lot. Production is down though, not just in China, but where it's done most, but everywhere else as well. But when you kind of think about these pluses and negatives, and this is why the NBER's dating committee is saying probably not, right? And this is why also economists are saying probably not. So now hopefully you know a little bit more about what really goes into a recession calculation than you did before. So what I care more about is not whether we're technically in a recession, but how should you be investing during a recession, after a recession, in that kind of thing. So once the recession's been declared, it's too late, right? So people pay a lot of attention to markets, right? Everybody in this room, I bet, pays a lot of attention to the markets. There are AI algorithms on the modern equivalent of supercomputers that scrape every bit of economic information and are connected to stock markets where their distance to the stock market is measured compared to the speed of light, because that's how fast they are reacting to the news. So news is in there already. We don't want to be competing with that. You don't want to be competing with that. By the time the news has made it to your newspaper or television screen, the computers have been all over this, and all the algorithmic traders too. So it's way too late at that point to call anyone and say something to do about it. So the information is in there, and the question that maybe you could ask yourself is, do you know so much more than the rest of the market does? Like, if somehow you knew that the best information, the best minds, all the investors who have, right, they have every incentive to try to beat the market and be smarter than the market. Are you smarter than all of those people, and do you know more than they do about the future of markets? And you know, maybe you do, but in aggregate, for sure, on average, the average person is going to be wrong on those calls. Every study has said that the more people that trade, the worse they do. When there are academic, like Charles Schwab and other major brokerage firms have actually given finance professors access to all the private data of everybody who has an account, and they were able to very clearly show that these, anonymous accounts, that the more the account traded, the lower the wealth ended up. And these are really solid relationships with really strong statistical relationships to back them up. This is a lot of information. This is a lot of information about how much information there is in markets, how forward-looking they are, how much incentive there is for financial professionals to be forward-looking. And so what does that mean for investing in a recession, sorry. So it means that by the time the recession has gotten there, it is too late. If you actually, I think on the next slide, one thing we looked at was after the event happens, after you're in a bear, in this case, what we're looking at is after you're in the bear market. But this same type of research would say, after you've been declared in a recession, what do forward-looking returns look like? Which is very relevant to the situation we're in now. We know a lot of bad things have happened. We all kind of wished we'd had the crystal ball 6 months ago, but we didn't. So we are where we are. And what does it mean for investing going forward? And so what you will generally find what we would find in a market environment like this is that going forward, investors are somewhat uncomfortable. Capital is a little bit scarce. Some people are pulling out of the markets. What does that mean for the people who are staying in markets? It means that future volatility is a little bit higher, but also future returns tend to be a little bit higher. It's by no means a guarantee, but this is an examination of just bear markets. Unfortunately, there's not a huge amount of data out there. You have to be a little bit smart about interpreting the data. But the data is pretty clear, and it fits with economic theory, that going forward, it's if anything, a slightly more rewarding time to invest There will be volatility, right? Past returns don't mean very much for future returns. Past risks do tend to keep reverberating a little bit. So when there is a lot of volatility in the market yesterday, there's likely to be a lot of volatility in the market today. When yesterday the stock market went down, that does not mean that today the stock market is likely to go in either direction particularly strongly. If capital is scarce, then that means that there is a higher reward for people who are still investing. So that's the typical recession or bear market scenario where the investors in the riskier assets tend to get rewarded better over time going forward. So from my perspective, this doesn't mean there's a free lunch. It doesn't mean that, oh, hey, bear markets, recession, everybody's scared. Let's just, I wasn't investing for the last 20 years, so now I'm going to start investing. That's a very bad idea. There's no free lunch because there is risk there. But what it does mean is that if you're in a portfolio that you're comfortable with, if you had a balanced portfolio with a well-diversified and everything that you have been comfortable with for a while, then it's very likely